we are likely to see some slowing in hiring relative to what we saw last month. But I think the thresholds that the markets are focused on is roughly about 300,000. If it's anything around that and above, that would be very hawkish and would potentially push the Fed to hike by 50 basis points in March. If there's anything around 200 around consensus, that would be on a less hawkish side. But I would say that whatever the number, the Fed will have to stick to its very hawkish stance because the market is very tight. And this one number is not going to change the outlook, at least in coming months.
Anna, well, as we talk about central banks, usually the terminology, we don't just get moves on the back of one piece of data. So another hot number on the labour market would reinforce a series of different data points around the labour market not cooling enough. But if we get a wildcard number that is much lower than anticipated, what does that do to the psychology, to the thinking for the central bank? Because it goes back to being one piece of data, one strange piece that they have to fit into a jigsaw puzzle.
Yeah, that's right. I guess if it's much weaker, it depends on the detail, but they could argue that it's more about risk management and they could be consistent with the 25 basis point hike that they flagged. We actually don't think it's about the pace of hikes right now. It's more about the terminal rate. Where it gets to, and we think that actually the risks are very much still skewed to the upside relative to what the market is pricing. And also, it's about how long the Fed will stay at the terminal rate. So we are less focused on the pace of hikes and more about the destination and how long we stay there.
Well, let's talk about financial conditions in connection with that, Anna. I just mentioned Credit Suisse called down 3.5%. We've got a call now on UBS, 3% lower in pre-market from Julius Baer. So this looks as though it's less about the individual banks and more about some of the ripples in the banking system after the SVB episode overnight here. To what extent do you think financial conditions are appropriate now in the Fed's eyes, or do they need to see more tightening? Do they need to break more things, whether it's the job market or whether it's some of the financials?
I think this is a very interesting question because it seems to me that what we're seeing is probably not systemic, given this one bank and the issues related. But we are seeing the ripple effects, and it's a warning shot. It's a warning shot to the market and to the Fed that this quite fast and large liquidity withdrawal will have repercussions. Financial conditions have been tightened a lot, and we will be seeing market stress here and there. And that's what I think the policymakers have been worried about. They just didn't know where to look. And they have been looking to more opaque areas like private equity, private credit. And I think that's one of the warning shots. Now, what this means, this might mean a little bit of caution from the Fed, but not just yet, because as we know, they're focused on the labor market, they're focused on inflation. That is very sticky, and we're not seeing that transmission working through to the real economy just yet. So they might be a bit more cautious, but as I said, I just can't see them changing their stance right now, given what we're seeing for the time being.